Hi friends, today we are going to discuss about everything you need to know about tax loss harvesting. This is a knowledge every investor needs to have. This is brought to you by The Unknown Sailor and I am Ashish. So let's get into the topic. Tax loss harvesting explained. Long-term capital loss will only be adjusted towards long-term capital gains. However, a short-term capital loss can be set off against both long-term capital gains and short-term capital gains. If you understand this, you don't have to watch this video. Else, we will have to go to the basics to understand this. The basics. You need to know what STCG or short-term capital gain means. What LTCG or long-term capital gain means. What is STCL, short-term capital loss? What is LTCL, long-term capital loss? So what is STCG and STCL? Gain means profit, only your profits are taxed. Short term means holding period is less than 1 year from the date of purchase of the security. So short term gain means profit made by selling a security in a time frame less than 1 year from the date of purchase. STCL similarly is the short term capital loss or the loss made by selling a security in a time frame less than 1 year from the date of purchase. So let's get into an example. You purchased 1000 stocks of Tata Motors on April 10th, 2021 at 260 rupees and sold it on June 10th, 2021 at 360 rupees. It is a really good trade because you made a profit of 100 rupees per share and that you had 1000 shares of that. So this is your short-term capital gain and that is 1 lakh in this case. Also, you purchased 1000 stocks of India Bulls Housing Finance at 255 rupees on 14th December 2021. Now, it is trading at 155 rupees. So you're still holding it because it is making a loss and the loss right now is 100 rupees per share or 1 lakh rupees of net unrealized loss. Remember the word unrealized losses. So now going to LTCG and LTCL. If you're holding a security for a period of more than 1 year from the date of purchase and if you're making profits by selling it, it is called as long-term capital gain. If you're holding a security for a period of more than 1 year from the date of purchase and you sell it by booking losses, it becomes your long-term capital loss. Let us go for an example even here. Let us say that you purchased 100 stocks of Reliance at 900 rupees per share in February 2019 and sold it on 21st December 2021 at 2100 rupees. In this case, you held the stock for more than 1 year or 365 days. You have sold it at a profit of 1200 rupees per stock. Since you have sold it, you have booked your profits, or in other words, you have realized it. So this is your long-term capital gain for the financial year and it will be taxed. Right now, the first 1 lakh of long-term capital gains that you do in any financial year is exempted from taxes, but from anything above that, you will be taxed 10% of your LTCG. You also purchased 100 stocks of Hero MotoCorp share at 3,500 rupees in October of 2017. The stock is still in your kitty because it is making losses right now and it is trading roughly at around 2,400 rupees when we make this video. And since it is in loss, you're not selling it, you hope that it will come back up someday in future. What is realized versus unrealized? You may have 100 stocks of a company, say X, which you purchased at 10 rupees, which you bought on 2017. And now it is trading at 10,000 rupees per share. And you will hold this share even now. You're not selling it. Even though your profit is 9,900 into 100, that is 9,90,000 rupees, you will have to pay 0 LTCG because you're not booking your profits or since you have not realized your profits. You may have 100 stocks of a company, say Y, which you purchased at 10,000 rupees and now it is trading at 10 rupees and you still hold this share. Even though this is your loss, in this case, again 9,90,000, your capital losses are still 0 because you have not booked them yet. You realize a loss or gain only when you book it, or in this case, only when you sell your stocks. Now to the tax implications. We know that STCG is less than 1 year, LTCG is greater than 1 year, so STCG is taxed at 15% flat out and LTCG is exempt of any taxes until you make your first 1 lakh gains and anything above that is taxed at 10%. Now coming back to the second slide of the discussion, that was tax loss harvesting explained. So now the point is long-term capital loss will only be adjusted with respect to long-term capital gains. However, a short-term capital loss can be set off against both long-term capital gains and short-term capital gain. Let us go back to your portfolio. So this is the portfolio that you have. You have Tata Motors shares which you have already sold, and your profit is 1 lakh in that case. And you are holding Ibul Housing Finance from 14th December 2021, and your losses in this case is 1 lakh right now, but you have not booked it yet. Same is the case with Reliance. You bought it in 2019, you sold it off in 2021. You made a profit of 1,20,000. This is your LTCG. Hero Motocorp, you bought it in 7th of October 2017. You have 100 stocks at 3,500 rupees, which is right now trading at 2,400 rupees. Unrealized loss of 1 lakh, but you have not booked it yet. So here, your short-term gain. So what is your taxes right now? It is 15% of STCG, which is 15% of 1 lakh. That is what you made by selling the Tata Motors stock. 15% of 1 lakh is 15,000 rupees. And then you have 10% of LTCG for LTCG greater than 1 lakh. Your LTCG is 1,20,000 that came out of selling Reliance stocks. The first 1 lakh is exempted. The rest 20,000, you pay 10%. So that is 2,000. So the total tax that you need to pay for your capital gains this year would be 17,000 rupees. Now let us come to the situation where you go for tax loss harvesting. So what is tax loss harvesting? You book your losses in Indiabulls Housing Finance and Hero Motocorp. That is, sell Ibul right now at 155. You realize a loss of 1 lakh rupees. Sell Hero Motocorp at 2,400 rupees. You realize a loss of 1 lakh rupees again. Now let us again do your tax computation. Your STCG now will be 1 lakh of profit from Tata Motors, but it will be cancelled out by the 1 lakh loss that you make by Indiabulls Housing Finance. So your STCG is 0 and the taxable income is also 0. Your LTCG right now will be 1,20,000 rupees made by Reliance minus 1 lakh lost in Hero Motocorp, which is 20,000 rupees, and this is less than 1 lakh which is exempted, and hence your LTCG is also, your tax on LTCG is also 0. A comparison in between the two: taxes paid without tax loss harvesting is 17,000 rupees. Taxes paid with tax loss harvesting is 0 rupees. You can anyways, if you want to continue holding Indiabulls Housing Finance and Hero Motocorp, sell it today, buy it tomorrow, and things will be fine. You can go and do that as well. Should you do this even if you don't have any profits at all? Let us say that in some time in future, you become profitable. And if you have higher amount of LTCG and STCG, you would have to pay out taxes. I mean, we are happy to pay taxes if we get our profits, right? So what happens in that case? Let us say today you're all losses, and in some time in future you're all profits. You can carry forward your losses up to next 8 assessment years from the assessment year in which your loss was incurred. So in the case of 2021, if you booked losses in 2021, these losses can be taken forward till 2029. Long-term capital losses can be adjusted only against long-term capital gains. It is self-explanatory and understandable because in long-term capital gains you get 10% exemption. So if that is clubbed with respect to the short-term gains, the government itself is losing 5% more, which they don't want to do. So they put that clause stating that, okay, long-term capital gains can only be adjusted against long-term capital losses. But short-term capital losses, in your case, you can either book it with, you can actually, set it off against long-term capital gains or short-term capital gains. But there is a clause again here. It cannot be carried forward if the return is not filed within the original due date. That is why should we do tax loss harvesting and put it into our ITR even when profits are not incurred becomes important. Yes, you need to do that. One last word here. This is just to reduce your taxes and it is not an investment approach. Okay, this is all about tax loss harvesting that I had to tell. If you have all your questions answered in this video, please let us know with a like, share and subscribe. Thank you for watching. This is the Unknown Sailor signing off. Thank you.